Well, let's head straight to Wall Street, where the markets have just opened for trade, and we are seeing sharp cuts thanks to the Apple stock, which is taking a beating. The tech major has cut its second quarter sales forecast, blaming a slowdown in China. And this is the first cut in Apple's forecast in more than 15 years. And that is clearly adding to the pressure on Wall Street. So let's bring up the Dow for you. It was down, and the S&P is down by about 1% right at the start, and so are the Nasdaq as well as the Dow Jones. It's not looking like a good opening there for the US markets. It was expected to be a weak open, and that's exactly how it's panned out. Well, speaking of Apple, here's CEO Tim Cook in an exclusive to CNBC on the situation in China and the reason behind Apple cutting its sales guidance for the first time in 15 years.
If you look at our results, our shortfall is over 100% from iPhone, and it's primarily in Greater China. And so as we look at what's going on in China, it's clear that the economy began to slow there for the second half. And what I believe to be the case is the trade tensions between the United States and China put additional pressure on their economy. And so we saw, as the quarter went on, things like traffic in our retail stores, traffic in our channel partner stores, the reports of the smartphone industry contracting, particularly bad in November. I haven't seen the December number yet, but I would guess that that would not be good either. And so that's what we've seen.
Well, that's Tim Cook on what's causing the slowdown for Apple sales in China, which has forced the company to cut its guidance. Back home, markets struggled in trade with both the Sensex and the Nifty losing 1% for the second day in a row. The Nifty giving up the 10,700 mark. This amidst a sell-off that we saw in banks, oil and gas, and the metal stocks. The Sensex down almost 400 points today. Mid-caps succumbing to selling pressure also post-lunch, ending with cuts of 150 points. So not looking good for our markets, and global cues don't bode well either. Well, the top story tonight, alarm bells for the economy. Fresh investments across sectors have stagnated to the lowest level in the last 14 years. And that is a crucial finding of a report released by the Centre for Monitoring the Indian Economy, or the CMIE. In the third quarter of this financial year, the report shows that new projects have dropped to 1 lakh crore rupees, which is the lowest since the middle of 2004. Now, what's worrying is that the decline is secular, which means pretty much across every sector except construction. The continued overhang of bad loans, uncertainty in the election year are the key reasons cited by the report for this decline. And there's no respite for projects that are stalled either. Nearly 12 lakh crore rupees worth of projects continue to remain stalled, and this number has remained around the same mark for the last few years. With the elections approaching, the CMIE expects political uncertainty to weigh on sentiment even further. Mahesh Vyas here on the key highlights of the report and the reasons behind why new investments are crawling at the lowest level in 14 years.
Capital goods companies could be doing well, and we will not dispute that. The numbers at a macro level for investments are, as you rightly put it, sobering. So recent projects being announced actually falling, and this is not a plunge. It is not a sharp decline, but is a part of a steady decline that has been happening for the last 3.5 years. So if you do a proper time series analysis of this, and we did that recently, and we found that this is actually a trend that began somewhere in 2015 June, and after that investments have only steadily declined. So now you reach a point where you become a 14-year low, and this seems to be a part of a trend. If you keep on falling, you will become a 20-year low as well. So so A, this is part of a trend. B, there were expectations in June of 2018 that there will be a revival. We did see some projects increase in proposals being made. We saw an increase in the order book flow, and we anticipated an increase to come about. But that hasn't played out. The new investment proposal is still very, very low. The second thing is that there is also a fall in the revival of old projects. So you have a decline in revivals, and you have a decline in new investments. At the same time, in the December 18 quarter, we saw an increase in the stalled projects. There was one big 3 trillion ton refinery project in Maharashtra and Konkan region, which got stalled. So you see this, this increase in stalled projects and decline in new investment projects leads to a fall in the outstanding projects itself. So we are seeing the stock of investments on hand actually having fallen and fallen quite a bit.
Mr. Vyas, what would you guess are the main reasons? Is this a financing issue that banks have a hole and therefore they're not able to finance these projects? Or is it that there are too many projects that have been completed, like power, for instance, and not used and being dragged to the NCLT? What could be the reason for this long drought?
It is not a financing problem. That is clearly ruled out. So we even asked entrepreneurs questions as to why a project is stalled, etc. And the only people who say financing is a problem are those people who are actually not bankable. So if you really have a very difficult balance sheet, then obviously you have a financing problem. But if you have a decent project, then nobody says that financing is a problem. The recent refinery that got stalled because it had land acquisition problems, and it just couldn't get off the ground. The problem, you rightly pointed out that a lot of projects have been commissioned already and capacity utilization is still low. So the expectation of capacity utilization rising, what we saw in Obicus in June 18, has actually come down again. So the problem is more to do with demand.
Well, new projects at a 14-year low. That's the big finding there from the CMI. Mahesh Vyas speaking to CNBC exclusively. Less than 100 days to go before the Lok Sabha elections and nearly a month after the electoral defeats in Rajasthan, Madhya Pradesh and Chhattisgarh, the government is planning a multi-pronged agri-relief package. Now, according to highly placed sources, the key objective of the new potential measures is to reduce the input costs, improve income security and increase the minimum support price. Pariksha joins us now with what the options are that the government is currently considering. Pariksha, time is running out. What can we expect? What's on the table?
We're hearing from our top sources in the government that the centre is discussing the possibility of bringing in universal basic income, but no decision has been taken as yet. There are concerns in the government. There are reservations with the cost to the exchequer. This scheme would cost about 2.1 lakh crore rupees, and this is a huge cost to the government in an election year. There are officials who believe that the government would be better placed to actually focus on existing schemes and their better implementation. Very soon we could hear the government announce 4 to 5 measures as a comprehensive package for farmers across the country. So what are some of the changes that are being looked at? Sources are telling us that all the changes would be aimed at income security, at reducing the input costs, increasing the MSP of crops, and at the same time provide additional sources of income for farmers across the country. There are also changes being looked at in the Pradhan Mantri Fasal Bima Yojana to ensure better implementation, faster settlement of claims. We are also hearing that the government is likely to include damage by animals to crops in the Pradhan Mantri Fasal Bima Yojana. This has been a demand from farmers across the country. As far as the KCC is concerned, the government is looking at several measures. Number one, to increase collateral-free loans under KCC to about 2 lakh rupees, also include livestock farmers under KCC. This is something that could be announced in the weeks and days to come. At the same time, push for wider coverage of the KCC scheme. Currently, the scheme covers only about 50 to 55% of the farmers in the country, and they want to extend it nationally to more farmers and bring more farmers under the net. They're also saying that they're looking at converting KCC cards to Rupee cum debit cards so that farmers have more income in their hands, and not just the Raitu Bandhu scheme, but schemes of Haryana, Madhya Pradesh and Rajasthan are also being looked at. And very soon there could be some good news for farmers in the country. This is something that Gajendra Singh Shekhawat, MOS Agriculture, also told CNBC TV 18.
Well, let's see what is going to be fiscally and administratively possible. Parikshit, many thanks for joining us. Well, the Prime Minister, speaking at a rally in Punjab's Gurdaspur today, reiterated the government's promise to double farm income by 2022, but no word on any potential new measures that could be announced immediately. Listen in.
हमारी सरकार वर्ष 2022 तक किसानों की आय दोगुनी करने का बहुत ईमानदारी से प्रयास कर रही है, निरंतर जुटी हुई है। साथियों, खेती को लाभकारी बनाने के लिए सरकार निरंतर ऐसे फैसले ले रही है जिससे समस्या को प्रभावी तरीके से खत्म किया जाए।
Well, that is not just a tall task, but almost an impossible one with the current rate of growth and the expected or the asking rate of growth to double farm income by 2022. Now, in a move that could bolster the government's arguments against the strict banking regulations, a parliamentary committee on finance has asked the Reserve Bank to ease its capital requirement rules. The panel, in its report, which was tabled today, stipulated that the norms by the RBI were unrealistic and unwarranted when it comes to capital ratio. Ritu Parnabhuyan joins us now with the details. Ritu, this should be music to the ears of the government, whether it's on the capital adequacy ratio for banks or it has to do with the PCA framework, pretty much highlighting what the government has been saying all through.
That's right. According to this panel, 11.5% of CRAR is unrealistic and unwarranted. And if this is waived off, then 5.34 lakh crore that could come into the banking system. The committee has expressed concerns on increasing loan write-offs and decreasing loan deposits. But it is also said that the present crisis is transient and should not become an excuse for privatization. As far as NPAs are concerned, the committee has said that the NPAs should be divided into two categories. Firstly, NPA categories where there are willful defaulters, and secondly, a category where the business house did not have any control and the NPA happened because of extraneous reasons. Last but not least, on PCA, RBI has come in for criticism by this panel, and RBI has said that the objective of the PCA framework has not been achieved. That's because parties with NPAs have no motivation to pay back. So this is all what the panel has said in its report, which was tabled today.
All right, Ritu, thanks very much for joining us with that. And staying with banks, banks have written to the new RBI Governor, Shaktikanta Das, listing out their grievances. First on the agenda was the February 12th circular to deal with resolution of bad loans. We learned that banks have once again asked the Reserve Bank to do away with the rule and instead allow financial resolution to start only after 60 days. Banks have also requested that the NCLT referral for bankruptcy proceedings must be initiated only after 60 days instead of the 15 days stipulated currently. Further, banks have requested the central bank to allow a resolution plan to be passed with 66% majority of the lenders instead of 100% approval rate. So that's the CNBC TV 18 exclusive. Banks asking the Reserve Bank governor for relaxation across the board, but specifically from the Feb 12th circular. Popular noodles brand Maggi has pushed Nestle towards oodles of trouble yet again. The Supreme Court reviving the government's case against the FMCG giant at the National Consumer Disputes Redressal Commission. The government has been claiming the presence of high lead content in Maggi and is seeking damages worth 640 crore rupees through a class action suit. Nestle has dismissed the allegations. Let's go across to Ashmit Kumar. He's been tracking that story. Ashmit, trouble for Nestle as the ghost of Maggi is back?
Indeed, a ghost that, in fact, we saw last in the year 2015. That's when there were two parallel cases. One where Nestle itself had challenged the ban order, the Maggi ban order. The other was the government initiating India's first class action suit in the NCDRC, seeking damages of 640 crore rupees. Now, both these cases culminated before the apex court. The Supreme Court had directed for a Mysore lab to conduct tests on the lead and the MSG content, and that report was submitted before the apex court in the month of March of 2016. The question that arose today before the apex court is, what about the way forward now? As far as the report itself is concerned, it is cited as a clean chit by Nestle. Nestle says that the report says that the lead is within permissible limits. However, the report itself concedes that they've been unable to ascertain whether the MSG that's present in Maggi is occurring naturally or has been introduced artificially. Now, on the back of that, the apex court has now remanded the matter back to the NCDRC, and in doing so, it has revived the government's class action suit. Now, as of right now, it's directed the NCDRC to evaluate this Mysore lab report. Further, the apex court has said that all rights and contentions are open. What that effectively means is that the government can argue afresh. Their argument has been that there has been high lead content, high MSG content. They can continue to argue that. They can continue to even seek damages of 640 crores and can also challenge the Mysore lab reports itself. So clearly a new battlefront being opened, and that old ghost of the Maggi ban resurfacing, this time, of course, before the NCDRC.
Okay, Ashmit, thanks very much for joining us. Tough times there for Nestle with the ghost of Maggi returning. Time now for a quick break, but when we return, 2018 has been a roller coaster year for startups. While some large startups have raised big investments, others struggle to make ends meet. How did they fare at the end? We discuss Local Circle's special survey with Sachin Taparia right after this break. Well, 2018 was a roller coaster year for startups. While some large startups were able to raise big investments and others got sold to global giants, many continue to struggle while making ends meet. The angel tax has not made the life of an entrepreneur any easier. So local circles conducted a survey to check the pulse on how startups have fared in the year gone by. Now, according to the survey, 38% of the startups who took part in the poll received at least one income tax notice in 2008. This compared to 2017, where the number was 37%. That's not all. Only 18% feel that they've benefited from the Startup India scheme. Sachin Tapadia, the chairman and CEO of Local Circles, joins us now to discuss the findings. Sachin, many thanks for joining us. We've done several shows here on the angel tax issue, and that's clearly showing up in the survey. How many people surveyed, and is this the #1 problem that they're talking about?
So 15,000 unique startups surveyed in the survey, 40,000 responses, and across 9 questions. And clearly, angel tax is one problem that is affecting the startups at the seed stage and at the angel angel funding stage. And the worry here is that if these startups that are at their early stage are not able to raise the funds, then will we really have the unicorns 5 years from now, that we have seen in the last couple of years? So
what's the big issue? Valuation and the fact that the income tax department, according to startups, doesn't understand how they're being valued.
Right. So 2 issues. One is, when a startup goes to an assessing officer, they typically go with a valuation report, which is based on the DCF method, which is discounted cash flow based on future earnings, because startups are all about potential, right? And the assessing officer in many cases says that, look, I'm going to value you basis the net asset value method, the NAV method. So that's the disconnect. So the startup says, look, my share is worth 600 rupees. He says it's worth 12 rupees, right? And therefore, I'm going to take the remaining amount and apply it to your, income other sources. And therefore, you pay 30%, 30.9% tax and penalty on top of that, because this is for a year in the past, right? So that's the concern, that, look, discounted cash flow is not being accepted readily. In many cases, the startups are being held accountable for the projections and delivering, exactly to those projections. Which is, startups, grow up in an uncertain environment.
So saying that you projected this much, but you haven't been able to deliver, and
That's right. So what we have basically requested the government is 2 things. One is, they've already acted. They've said, no coercive measures to collect the funds. The second thing is that, accept DCF, orient the tax officers. We've had a question in the survey. 97% of the startups have said that, orient, give them, video orientation so that the way they understand startup valuation. So the right questions are being asked, and the harassment, minimizes.
So what about the year ahead now? What's the sentiment like in the startup universe as per the survey?
So the top concerns is, 45% people say that it is the corruption and bureaucratic inefficiencies, which is, where I would put angel tax in that bracket. About 35% people say that it is about funding, and the remaining say it's about, growth and growth challenges, basically.
And how many intend to hold on? How many intend to sell out? What's the prognosis?
One thing that we saw deteriorating this year is 24% people are saying that we are looking at wrapping up our startup or shutting it down, which was 11% last year. The remaining, 71, 75% looking at, growing their startup, obviously. So that's a concern that we have got to figure out. But is this a normal
sort of business cycle? I mean, startups fail world over, so it may not necessarily have anything to do with the specific regulatory challenges.
It is, but at the same time, so many people or so many entrepreneurs expecting that their startup would shut down. I'm sure a good bit of it is because of the angel tax notice, which, they raised money in 14, 15. The notice has come now, right? They're not having that level of cash that they had at that time to be able to pay up that notice or, serve it or service it. And that's where I think some of the challenges are also, coming up.
Okay, so the mood in India's startup ecosystem not looking particularly buoyant. That's the findings of the Local Circles survey. As we've pointed out, tax-related concerns continue to haunt the startup ecosystem. In fact, 2017, also the angel tax issue was almost, 33%, and today it's 34%.
It's pretty much the same, and I think that is where we are looking for some relief, from the budget. which is, maybe for DIPP recognized startups, there is this angel tax.
Yeah, but DIPP is saying nobody's coming to us for recognition.
And I think that is the challenge, that, you have a level 1 recognition where you have 16,000 startups that have, recognized themselves. And then you have this investment board, which is a much more tedious process. So our submission to them is, make it easy. You can say all DIPP recognized startups get the exemption. And then, ask them to submit additional documents. And if they don't, then, do the derecognition. But at least, do a big bang and, get rid of the angel tax.
Okay, all right. So not looking good there. That's the findings of the local surveys, Circle survey. Sachin, many thanks for joining us, and Happy New Year to you and your team. With that, it is time for us to wrap up this edition of What's Hot. Thanks very much for watching. Don't go anywhere, because we focus on the Lal Street, where weak global cues and continued FII selling drag the markets lower for the second straight day. Benchmark indices down 1%. Markets Today Talk Back takes the action forward. I'll see you again in 30 on India Business Hour.